It's my pleasure to welcome back Tamara Telesko. She is the Director of Wealth Planning Strategies at TIAA. She is an attorney. She is admitted to the bar in the Commonwealth of Pennsylvania. She has her JD from the University of Pittsburgh. She doesn't have a big presence on the web, so she's elusive, and I have trouble finding information about her. I've mentioned this before, but I hadn't remembered that her BS is from West Virginia University. But I did find out something new, which is there was a time when you were a member of the board of the Certified Financial Planner Group, and which I hadn't known before. So with that introduction, I turn the floor over to you, Tamara, and we have some new people, but many returning people, I can tell from the guest list.
Great. It's great to be here. I always enjoy it. It's always a highlight of my week, day, month, whatever. I enjoyed talking with you. If you have any questions during the presentation, feel free to either use the chat box or raise your hand, whatever you're comfortable with. But as I said in the beginning, for those of you that weren't on when I was talking, for those of you that have been listening to me many, many times, thanks for coming back. I enjoy talking about taxes. I know, call me crazy, but I do. And for those of you that haven't, believe me, there's going to be a lot of information here. Feel free to ask questions. Don't be embarrassed. No question is too elementary or maybe too complex, but I'm happy to field anything that you may have. And if you don't feel comfortable doing it in this form, please, you can email me at any time at your leisure, and we can talk about your situation. So with that, let's get started. Okay, I have a presentation, so let me share my screen. Okay, this is basically, I titled this Updated Items of Interest because we're going to go over a myriad of things. Let me go down here. Okay, I want to make sure I can get to the next slide. Is there a way of getting to the next? There we go. Okay, so basically, this is just saying I don't give legal advice. I mean, basically, I'm here to educate you as to what the tax laws are. We want you to go to your own attorney, own accountant to talk about these things in your particular situation. So what are we going to cover today? Let's get started. Today, we're going to cover the following topics: the Secure Act. Now, I realize that we did review this during our last presentation. However, I do want to ensure that everyone understands what changes were made to retirement plans and planning for retirement because of the Secure Act, which was passed on December 20th, 2019. It's already been 2 years plus since this act has gone into effect. In addition, we're going to review the proposed regulations for the Secure Act. The IRS released on February 23rd of this year. So it took them 2 years to come up with proposed regulations for this Secure Act. And what they do with the regulations is basically they talk about what people are questioning about the Secure Act. And then the IRS comes back and comes out with regulations that kind of make it clearer what was meant with the Secure Act. Basically, the proposed regulations provide guidance on the required minimum distribution rules set out under the Secure Act and apply to required minimum distributions from qualified retirement plans, including IRAs, 401ks, and 403b plans. Then we're going to review the proposed Secure Act 2.0, which has recently passed the House and is on its way to the Senate. Secure 2.0 is widely expected to be passed sometime this year, given, as I mentioned at the beginning of this is one of the few things that has bipartisan support. However, it probably will go through several stages because the Senate also has a similar bill on the topic. So it's passed the House, now it's sitting in the Senate. Then we're going to review the federal, New York, Connecticut, and New Jersey gift and estate tax exemptions for 2022, minimum income levels for the top income tax bracket, income limits to contribute to Roth IRAs, and capital gains brackets. And lastly, if we have time, I was asked to talk a little bit about Medicare Parts A, B, D, and Medicare. So if we have time, I'm more than happy to go over that. So let's really start, I guess, with the Secure Act. As I mentioned previously, the Secure Act was passed at the end of December 2019, over 2 years ago. It basically is an acronym for Setting Every Community Up for Retirement Enhancement. The Secure Act changed a variety of retirement account rules, including who's eligible to contribute to retirement accounts and when withdrawals are required. So let's examine the important retirement account changes that the Secure Act included. So what is law now is that the required minimum contribution age has been increased from 70.5 to 72. The age limit to contribute to IRAs has been removed. It used to be once you reached age 70.5, you couldn't contribute to IRAs anymore. Now, if you have earned income at any age, you can contribute to an IRA. Inherited retirement account distributions for certain beneficiaries now have to be taken within 10 years. This was the big change. The other ones were big too, but this was the real big one. Normally, or before this change, prior to this, this change, a beneficiary of a retirement account could roll it over into their own account. It was usually called an inherited account. And basically, the beneficiary could take it over their life expectancy. So you had a married couple, one died, rolled over to the spouse. That was a spousal IRA rollover to the spouse. Spouse could take it over his or her life expectancy. Then when surviving spouse died, it went to either children, friends, enemies, whatever. It was a non-spouse, and they could take it as an inherited IRA, and it could go over the life expectancy of that beneficiary. The Secure Act changed that. What the Secure Act said was any non-spouse or eligible beneficiary, and I'm going to get into what those terms mean, can take out over life expectancy, but any non-eligible beneficiary or spouse has to now take it out by year 10. There was no requirement to take it out before year 10, but by year 10, everything had to be taken out. So that was what we thought the Secure Act did, and that's what the Secure Act did. Every non-spouse or eligible beneficiary had to take out the retirement accounts by year 10. So the age limit for the loss of the IRA, stretch IRA, caused a lot of consternation, and you can see why. Look at this. If under the previous law, if you had somebody that was age 35, and they inherited an IRA. Under the present law, they could take distributions over, 50 plus years. Under the Secure Act, they're now having to take it within 10 years. So why is this happening? Well, the government wants their money faster, right? Because whenever you take a distribution from an IRA, you have to pay taxes. They're not getting it for 50 years under the old rules if the child took it over their life expectancy. Now they're getting it in 10. So you see in red here, I have proposed regulations and exceptions, and we're going to go through that later, but I wanted to highlight that. Now, the loss of that stretch IRA for designated beneficiaries is going to have different consequences based on different facts. So for example, if you have a $2 million IRA and you have 4 children that are going to be the beneficiaries of that IRA, each child's going to get $500,000 that they have to take out by year 10. Now, while that's not ideal, that means even if they took out $50,000 over 10 years, that's probably not going to get them in a higher tax bracket. So they can do some tax planning. That, if you have multiple beneficiaries, this change maybe isn't as significant as if you have one beneficiary. Say the same $2 million IRA goes to one child. Now that child, even if they spread it over 10 years, is taking $200,000 a year out of that IRA. That could have significant, consequences. So I can't emphasize enough, tax planning becomes a large part of IRA planning when you're inheriting IRAs by non-spouse.
Call from Bedford and why?
That's not me. Okay. So remember I had the red highlighted and I said there's categories of IRA beneficiaries that are now under the Secure Act. There are 2 additional ones besides spouses, and spouses actually go in there. There are designated beneficiaries. So designated beneficiaries are what I was talking about. They're non-spouses and they're non-eligible designated beneficiaries. So that's like if a child inherits, if a friend inherits, and they don't have any special circumstances, they're what's called a designated beneficiary. And they are the ones that have to take it out within 10 years. There are 2 other categories of IRA beneficiaries. There are non-designated beneficiaries and there are eligible designated beneficiaries. The eligible designated beneficiaries do not have to take out inherited IRAs within 10 years. They can take it over their life expectancy. And those include spouses who can roll it over into a spousal IRA and take it over their life expectancy, disabled or chronically ill individuals can take it over their life expectancy, beneficiaries who are not more than 10 years younger than the decedent can take it over their life expectancy, and minor children can take it up until over their life expectancy up until the age of 21. Once they reach age 21, they have to take it within 10 years. So that's a kind of class that they've carved out from this 10-year requirement. Non-designated beneficiaries are things that you name as a beneficiary, such as your estate. There's no life expectancy with an estate. If you name an estate as your beneficiary, that IRA, whoever ends up with it, is going to have to be taken over 5 years. If you name a charity, there's no life expectancy, right? The charity gets the funds, and there's rules. If you name a charity, in order for it to qualify, the portion of the charity that you name as your IRA beneficiary has to be paid out by September 30th of the year following the decedent's death. And certain trusts qualify as eligible designated beneficiaries, and certain trusts do not. And if they do not qualify, if they're not structured properly, those would have to be paid out over 5 years. So I wanted you to understand that that 10-year rule does have a carve out for certain individuals. But think about it. If you have someone who is disabled and they are qualifying for government benefits, you still may not want to name them as a beneficiary on your retirement account, even though they can spread it over their life expectancy, because it may interfere with government benefits. There are limits as to Social Security, disability benefits, other federal disability government benefits, and there are income limits as to what that person can take in as income, and they're usually very low before they get disqualified from qualifying for benefits. So if you have someone that is disabled or chronically ill and getting benefits from the government, instead of naming them as the beneficiary, you actually may want to name a special needs trust, which does allow them to get assets or income from the trust that the government doesn't pay for, and it won't disqualify their benefits. So I just wanted to bring them up because a lot of times people mistakenly, I would say, name a person that is qualifying for government benefits and inadvertently disqualifies them for the government benefits. Okay, so what kind of planning can we do for this loss of the stretch IRA? Well, the first thing is, if you have a spouse, naming the surviving spouse does allow that spouse to, stretch it over their life expectancy. Now, you may have qualms about that spouse inheriting, right? It could be that they're not good with money. They may come under undue influence. They may remarry. What happens? And you want it to end up with either your children or someone after that surviving spouse passes away. What you can do is name a trust for the surviving spouse's benefit. That trust is called a Q-tip trust, Qualified Terminable Interest Property Trust. It qualifies for the marital deduction, so there are no taxes when that spouse inherits it in the trust. The trustee will distribute the required minimum distributions and or all income. The spouse has to receive all income, whichever is the greater of the two. And when the surviving spouse passes away, your trust determines who ends up with whatever is left in that. It's not up to the spouse. So that's something you may want to consider, just elongating the benefits of the life term for a spouse. The other thing you may want to consider doing is starting to convert some of your traditional IRAs that are subject to income taxation when you take distributions to Roth IRAs. Now, when you do that, you have to pay income taxes. Nobody likes to pay income taxes that they don't have to. This is really a benefit for your ultimate beneficiaries. So it does help you in the respect that if you convert any of your traditional IRAs to Roth IRAs, you're not required to take required minimum distributions during your lifetime or during the lifetime of your spouse. So if you don't have a need for an IRA income, it may be beneficial for you to start converting. And when I say start converting, you don't have to convert the whole IRA. What I usually recommend people do is they talk to their accountant, or if you do your own tax returns, you figure out how much income you can bring in any given year and not get you into a higher tax bracket. So this only really works if you're not in the highest tax bracket. But if you can bring a little bit of extra income in every year and start converting some of these assets from income taxable to, long deferred IRAs, it is really a benefit to your ultimate beneficiaries more than it is to you. And if you're charitably inclined, what you can do is you can do what's called a qualified charitable distribution from your IRA every year up to $100,000. What that is basically a transfer. It allows you to make a direct gift to a charity from your IRA to the charity up to $100,000. That gift or that to the charity is not included in your income. You do not get an income tax deduction for it. However, it does satisfy your required minimum distribution for the year. So if your required minimum distribution is $50,000 and you give $50,000 as a QCD to Columbia University, that's it. You've met your required minimum distribution. You don't have to recognize that 50 as income, which you would have done if you brought it in as a regular required minimum distribution. And this might help you for Medicare premiums or how much of your Social Security benefit is taxable. Because with Medicare premiums, your premium is based on your adjusted gross income 2 years ago. So if you keep it low, your premium for Medicare may be lower than it would normally be. And with Social Security, as you know, that's how much is taxable depends on your adjusted gross income. So if you're not including it in income, your adjusted gross income is going to be lower. So that's something you may want to consider doing also. The other thing, many of you are charitably inclined and want to leave assets when you pass away. Making charitable beneficiaries part of your beneficiary designation makes a lot of sense because charities don't pay taxes. So, you leave $10,000 to Columbia University, that Columbia University gets the whole $10,000 versus if you left it to an individual, as we talked about before, they have to pay income taxes on it. The other reason I like doing it this way is if you want to increase or decrease whatever you're giving to charity, all you have to do is go online and increase it from 10,000 to 100,000, right? You don't have to go back to your attorney if you were doing it through your will and have a codicil drawn up to say, I want to increase whatever I'm giving to charity that way. So it's just a lot easier. It's tax efficient. It's a lot easier to manage. You can go up and down on whatever you're giving to charity. Because, sometimes you change, you knew somebody that was at the, Heart Association and now that person is gone. So maybe you don't want to leave it to the Heart Association. You want to leave some money to another charitable organization. And then another technique, and I'm going to go over this one briefly. It really depends on your circumstances. Some people, if they're leaving it to individuals and they don't want them to be stuck, quote unquote, with that 10-year rule, have implemented a change in their beneficiary designation from their designated beneficiary, let's say a child, to a charitable remainder trust for their benefit. Now, what that does is with a charitable remainder trust, the child, for example, would have a distribution from that charitable remainder trust for their lifetime. So you're kind of replicating the stretch IRA, but when the child passes away, whatever's left in there goes to charity. So you have to be very charitably minded, and it has to kind of fit with what your estate is, if it's subject to estate taxes, etc. But I did want to bring it up because some attorneys are recommending that for beneficiary designations on retirement accounts. There were some additional miscellaneous items that I just wanted to go over. And those were basically, I mentioned before, if you have earned income past the age of 70 and a half, you can make contributions to an IRA. They brought back the kiddie tax under the Tax Cuts and Jobs Act that was implemented under the Trump administration. There was some convoluted way of taxing children that had significant unearned income. It never really worked. So they brought back the old kiddie tax. And what the kiddie tax is if you have children under the age of 19, or if they're in college, between ages 19 and 23, if they have unearned income in excess of $2,300, it's going to be taxed in the parent's bracket. This was implemented because people were, gifting their children a lot of money because then they could get the different tax brackets with the children. And the IRS said, no, that doesn't work. If it's over $2,300, we're going to tax it to the parents. They're not going to get away with trying to get different tax brackets going. 529 plans were expanded. As you know, 529 plans are plans that you can contribute to, and the contributions grow sort of like an IRA. They grow tax deferred, and if the funds are eventually used to pay for college education or secondary education, culinary school, golf classics, things like that. You never pay taxes on the growth. You can just, write a check and pay for tuition. That was limited to secondary education. The Secure Act actually broadened it, so you can use up to $10,000 of that, tax-free to pay for K through 12 schooling, usually private schooling, obviously, but homeschooling costs were not included in that. And that was one thing. Ted Cruz was not passing the Secure Act because he wanted homeschooling, but it never went through. And then the last thing that was added for the Secure Act was $5,000 from IRAs could be distributed without penalty to pay for expenses for adoptions or expenses after the birth of a child. Now, that money is taxable, and it's in the discretion of the employer, so to speak, whether they have this provision in there. But if they do, then they can take out $5,000 without penalty, which means before age 59 and a half, use it for adoption, birth of a child, and they can repay it back. So, and there's no time limit as to when they can repay it back, and then they file amended returns, etc. But I did want to go over all of the things with the Secure Act. So, remember I mentioned that there were proposals. There are proposals. There were proposals made I'm going to stop this share for a minute because I don't have slides on this. There were proposals to the regulations on that 10-year period that a designated beneficiary had to take an IRA. We all thought that the way the rules were is you didn't, the designated beneficiary, a child, for example, didn't have to take out anything in any year up until year 10. And then in year 10, they had to take everything out, right? Or whatever was left in there, they had to take out. The regulations came out in February, and they're open now until public hearings are in June. And we were all wrong on that on one point. What the regulations are now saying is if a child, and I'm saying child, but it can be anyone, if a child inherits an IRA from someone who did not start taking their required minimum distributions, that would be the same as what we thought. They don't have to take anything. They can take it at any time, but by year 10, they have to take it out. The regulations are saying, however, if someone that they inherit the IRA has begun required minimum distributions, when the child or designated beneficiary inherits the IRA, they have to take required minimum distributions between year 1 and year 9. Then year 10, what's ever left, they have to take it out. That's a big change from what we thought. No commentators, no one thought that was going to be the rule, but those are the proposed regs. They're up for public hearings in June, and stay tuned. I will obviously notify you if that is the exact change that's going to be the law. But I wanted you to be aware. Yep, those are proposals though.
Tamara, there's one question in the chat. Can I contribute to a 529 for my niece's benefit?
Yes, by all means do it. Grandparents can contribute it to grandchildren. You can contribute it to your niece. If you're a New York resident, you should, and from a tax perspective, contribute to the New York plan. It doesn't matter. Every state has a plan, and every state has a limit as to how much you can contribute. What you should contribute, you can contribute up to $16,000 a year without any income tax problems, gift problems, anything like that. With 529 plans, you can bunch 5 years in a row, which means if you multiply 16 times 5, I think that's what, 60,000, if I'm not mistaken. In 1 year, you can do that with a 529 plan. It counts for your next 5 years of gifting. But again, that is deferring tax-free. If it's used for college education, it never gets taxed from an income tax point of view. If you are a New York resident, New York's plan is run by Vanguard. I encourage you to use that plan because you get an income tax deduction up to $5,000 a person. So if you're a married couple, you contribute $5,000 each of you, $10,000 total. You would get a $10,000 income tax deduction on your New York return. If you do another state, you're not going to get that benefit. That's why I don't like, they call the doing 5 years pre-funding, because if you put in 60,000, you're only getting a $10,000 deduction in New York. So my feeling is take what they give you. They don't give you a lot. I would probably max out at 10,000 every year if you're going to do it that way. You can stay as the owner of that account. And what's good about 529 plans is, let's just say your niece is a fantastic athlete and gets a full scholarship to Notre Dame. So you're never going to use that, or that niece is never going to use it. You can do you can do many things. You can do, forward that on to a nephew, another niece if you have one. They're transferable, or you can take it back. That's what's neat about these. They're completed gifts, but if the child doesn't need it, you can always take it back. If you take it back, however, you're going to have to pay income taxes on all the growth. That's the trade-off. But it is a really flexible tool. Anything else?
I had one question on the qualified term spousal trust, which allows for spreading out the proceeds from an IRA. Can such a person, the beneficiary of that, be more than 10 years difference in age from the spouse, from the husband or wife? You had said
more, yeah, anytime a spouse.
Yeah, because you had before said that a spouse more than 10 years age difference than the later actuarial eligibility didn't apply.
Yeah.
Okay.
A spouse can always take it over their life expectancy. It's really like if you have a brother and your brother's 2 years younger, they can't take it over their life expectancy if they're the beneficiary. So I just wanted to point that out. There's all these little different rules that we have, and I'm glad to summarize this if you want to. There's a lot of different things going on here. The other thing I wanted to mention, and that's why I took it off, was so we have the Secure Act, and I wanted level set so everyone knew what the laws were today, maybe up and down with that 10-year rule. But other than that, you have a good handle on what the law is today with retirement plan. So just when we had knowledge about what was supposed to happen with retirement plans, up comes Secure Act 2.0. So the House on March 29th, this is just the House passed Secure Act 2.0. It has a different name, but everybody's calling it Secure Act 2.0. And basically it has a whole trove of different things that they're doing. So I wanted to go over those for you. These are just it's just the House passing. This is not law. And the Senate has its own bill that's very similar, but has differences. So this is now in the Senate. The Senate is probably going to make some changes, but I want you to know what the House is proposing. And I only went over the ones that really apply to individuals. There's a lot of things with plan benefits and things like that. I didn't go over those. But the first thing is we raised in the Secure Act from 70.5 to 72 required minimum distributions. Secure Act 2.0 is raising it again, raising it 3 times. So the age for RMDs would initially increase to 73 when you'd have to start taking out required minimum distributions starting next year, January 1st, 2023. Then the age would increase to 74 beginning on January 1st, 2030. And then lastly, the required minimum distribution beginning date would increase to age 75 on January 1st, 2033. So they keep elongating when people have to start taking out minimum distributions. Basically, I'm not quite sure where they're doing it. They're saying this is a tax revenue generator. And the only way I can figure out this is a generator is if you elongate when people can take it out or have to take it out. That means it's accumulating more. and they're taking out bigger tranches, which maybe gets them in a higher tax bracket. I can't quite figure this one out, but they say it's a revenue generator. I have to tell you, only 20% of Americans wait until required minimum distribution to take out the money from their IRA. So this is really, I think, going to be for people in the higher tax brackets that don't need the money. And maybe they're thinking they're going to convert them to Roth IRAs, which generates a lot of money for the Treasury. I'm not quite sure where that one's going, but I wanted to mention that's one of the proposals. The other thing is they say Americans don't save enough for retirement. That's not this group, I know, but in general, that's why all this reform is going on. So what is being proposed under Secure 2.0 is workers, and it only applies to workers who are age 62, 63, or 64. They're going to allow them to do catch-up contributions of $10,000 each year to 403B plans, 401k plans. And if you have simple IRAs during those 3 years, you can add an additional $5,000 each of those 3 years to simple IRAs. Now, as you probably know, if you contribute to an IRA, people over 50 can contribute a measly $1,000 more. And that's been in effect, I think, for 15 years. Finally, they're saying, okay, we're going to increase this for inflation again under this proposal. So that's another benefit. And that would be for anyone 50 years or older. One that might actually be kind of interesting is, remember those qualified charitable distributions I talked about that can come directly to charity and they're capped at 100,000. This act would increase that 100,000 for inflation, which I think should probably happen. I think that's a good idea. But they have a second one in there on qualified charitable distributions. I don't know how they're going to implement it, but I kind of like it. It would allow a one-time qualified charitable distribution transfer of up to $50,000 to a charitable gift annuity or a charitable remainder trust. So you could actually give money to a charity and get some money back. I think it's kind of interesting, or give it to, someone for someone else. If you want to do a charitable annuity trust for, a child or something. I think it's kind of interesting. I don't know how it's going to be implemented because I don't know how many charitable remainder trusts can operate on $50,000 because they tend to be, they're not cost effective. But the charitable gift annuity, I think it could have some legs to it. So I wanted to mention that. Another provision is RMD penalties. When a person, well, first of all, if you don't take your required minimum distribution, I don't know whether you knew this or not, but you are subject to a 50% penalty. It's the worst penalty in the world that the IRS has. Now, that being said, I've never known anyone that has had to pay that, because if you can say you got bad tax advice, or if you're ill, you're out of the country, you have a good excuse, and then you eventually take it out, the IRS usually waives the penalty. That being said, where this comes in sometimes, though, more often, not when you're alive, it's when you're dead. Because when you pass away, you have an IRA, you have to take your estate has to take out your required minimum distribution for that year. So if they fail to do that, that could result in this 50% penalty. So what they're doing now under this proposal, it's not changed yet, but they would reduce the penalty to 25%. And if you eventually pay it out, it reduces to 10%. And again, if you have a good excuse not for doing it, they'll waive it. But I did, some people don't know about that. So the last year of a person's life has to take out their required minimum distribution. So think about it, that 10-year is actually 11-year, because when the person dies, they have to take out the required minimum distribution and it's on their tax return. The beneficiary has to really start in year 2, which is year 1, basically. So you actually get 11 years rather than 10, but that's another story. Another one, if the company does it, and this is just a throwaway, but it might have some importance for you. A lot of people starting out have student debt, and the student debt is significant, and they can't afford to contribute to a retirement plan. What this proposal would do is allow employers to match an employee's contribution to pay off debt. So the employee is actually not contributing to the company plan, rather they're paying off debt, but the company will match whatever they do. That's a voluntary plan. The employer can opt in on that, but I think that's kind of unique. I like that one. Another one is they're going to implement a lost and found for old IRAs, old 403B plans. Many of you might have, worked at Duke University and now you're at Columbia. And when you were young, you had an old retirement account there, or you contributed, but you never really kept up with it. They want to do a repository, a national online lost and found database for retirement plans, which I think is great. I know, I found old life insurance policies for people. So if you can find an old plan that you never, contributed to after you left the institution, and now it may be worth a lot of money, I think that would be kind of cool. Other than that, I think, they'd allow more Roth contributions. So Secure 2.0 would allow simple and SEP IRAs to accept Roth contributions from employees. Now you cannot do that. Would also require the catch-up contributions on, your 403B to be subject to Roth treatment. So they're trying to make this more tax friendly, I think. And I'm going to go back. Let's see, I want to share my screen. I wanted to go back to I don't know, it's not working now. I did want to go back to the fact that, let's see here. The fact that the uniform table has changed. So basically, the IRS is finally realizing that people are living longer. So the uniform tables have reflected that. The change actually took place in 2019, I believe, which would have been effective for 2020 to elongate the life expectancies. But unfortunately, the pandemic hit. And don't forget, in 2020, you didn't have to take an RMD. So they did not implement the change in the unified tables. And then the pandemic went through 2021. They again didn't have the change in the tables. But by 2022, which is this year, they decided, yep, we can start implementing this. So I wanted to try to show you the difference in the change. I'm not sure why I can't get it. It's not dramatic. It's about, you know, a few percentage points, but, you know, I thought it might, you know, be helpful to know that there are some, I don't know why this isn't working. There are some changes to the life table. Okay, let's see, maybe that's why. I don't know, it's not working and I apologize. The only other thing I was going to talk about is Medicare. And I mean, I could go over, you know, some of the parts of Medicare. You have Part A, which basically pays for hospital care. You have Part B that pays for, you know, doctors. And then you have Part D, which basically covers everything else. You can go with a Medicare plan and stay with the original Medicare, or you can go with private companies. I mean, around this time, there are, you know, you have United Healthcare, you have all of these companies that have different plans available to people. The benefit of using Medicare and the original Medicare is you can use it anywhere that you go. So anywhere in the country, any facility that accepts Medicare, you can use. When you go more with the private companies, you use their doctors, you use their, and believe me, they have lots of doctors that are enrolled in these plans. But I think that's what I wanted to share. And I have, you know, I'm not sure why this isn't working and I apologize, but my system doesn't seem to be taking the next page, but there's premiums involved. And the only thing, if you have questions, if you're nearing Medicare age, I would strongly, strongly, strongly recommend that you get a publication from Medicare. It's called Medicare and You 2022. It's like 100 pages and it really goes over everything that you could possibly want to talk about Medicare. Any question you had is probably going to be answered by that. So I would suggest you get one of those. I can, if you want, I can download it and give it to you to pass out amongst all of you. But it really, really is a good, here we go, good booklet to keep at your bedside if you're qualifying for Medicare or you want more information on it. So here's the change in the tables. It's not that big of a deal. For a 72-year-old, if you were taking out required minimum distribution under the old tables, it was a 25.6-year life expectancy. Now with the new tables, the longer life expectancy, it's 27.3 years. So in the tax booklet, we were talking before all of you got on, TIAA has a tax booklet that goes into life expectancy tables and, you know, almost any kind of information you want about, you know, contributions and everything, which I'm going to send and will be disseminated among all of you. They have the new uniform table distribution tables if you would like that. I think that's important. Tax law changes, I think we went over. The federal exemption increased this year to $12,060,000 per person, and it's portable, which means if you have a married couple and the first spouse to die passes everything to the surviving spouse gets the deceased spouse's exemption amount, which means a married couple, assuming that correct elections are made, with a net worth of 24 million or below will pay no federal estate tax. So I think we're all pretty good on the federal estate tax. Where we may have some issues is with New York. New York increased their exemption this year to 6,110,000 per person, but it is not portable. And as we've said many, many times in these talks, the New York exemption is the only state exemption in the world like it. Because if your estate, when you pass away, is over 5% of this, which comes out to around $6,415,000, you lose the benefit of the entire exemption and you're taxed from $1. The way the New York exemption works is, the tax brackets for it, it's incremental, starting at 4%, and it goes up to 16%. So it is not insignificant. So what is your estate comprised of? Your estate for both federal and New York is basically everything. For New York, it is any death benefit on any life insurance policy you own, all of your retirement accounts, your home, your bank accounts, your brokerage accounts, stock, anything you own except real estate that is located in a different state. Real estate in any state can only be taxed by the state that it is in. So if you own a beach house in New Jersey, that would not be subject to New York estate tax. If you have a brokerage account with a broker in New Jersey, that is subject to New York taxes if you're a New York resident. If your estate is over the 6,415,000, which is where it totally phases out, you really should see an estate attorney, because there are ways of getting around this. It's called a credit shelter trust. If the first spouse is passing, the surviving spouse still has access to the assets, but they're not included in the surviving spouse's estate when they pass away. But it is something you have to have in your document in order to have it not be included in your estate. Connecticut's exemption in 2022 is 9,100,000, and it's a straight exemption. If you have, an estate of 10 million, you take off the 9.1 and 900,000 is subject to tax in Connecticut. And as I've said many times, and people are shocked, I'm glad you're all sitting down, New Jersey does not have an estate tax. However, it does have an inheritance tax. The difference between an estate tax and an inheritance tax is an estate tax taxes what's in your estate when you die. Like I said, insurance, retirement accounts, everything, and they apply the tax to that, and it's paid by the estate. An inheritance tax taxes who inherits it. And there's different classes of people. So for New Jersey purposes, the inheritance tax exempts spouses, children, parents, grandparents, grandchildren, almost anybody you would leave money to. But if you left money to a niece, it's taxed at 16%. Now, there are some exemptions from that inheritance tax, but it does, it really doesn't apply to too many individuals. And the annual gift increase this year, as I mentioned before, to $16,000. You can give anyone you want $16,000 without it being subject to any tax. You can give them, if you're married, you can combine that, and it's $32,000. This $12,160,000 exemption that I was mentioning for federal estate tax purposes is both an exemption for lifetime gifts or at death. So if you go over that 16,000, say you want to help a child or a niece or someone buy a house and you want to give them $100,000, you can do that. The first 16 will come off gift tax free. The remainder, you're using up some of this 12,060,000 exemption. You do have to file a federal gift tax return, but it's totally informational. It's a form 709. You file it with the IRS and you say on, April 19th, I gave $900,000 to my niece, and that's it. That's all you do. No money changes hands. When you pass away, on your estate tax return, which is a 706, the first line is, what is your estate? Second line said, did you make any taxable gifts during your lifetime? Your executor would check yes. What was the amount? 900. So it comes back in and then you get the full exemption amount again. So it's really just accounting purposes. So go over that 16 if you have to. You have plenty of room there to use it, but you will have to file a gift tax return. Just wanted briefly to go over the top income tax brackets. As you know, we were talking about this again before all of you got on. There were all kinds of things in the Build Back Better plan that President Biden was proposing that would have increased the highest bracket, lessened the amount of the federal exemption. None of that passed. None of it went through. So we still have a relatively low highest bracket. The highest bracket is 37%, and you can see where it kicks in. It kicks in at very high rates. For singles, it kicks in at 539,000, almost 540. Head of households, the same. Married filing jointly, it kicks in around 648, I would say. And married filing separate is basically half. Now, I want to point out how trusts are different than you and me. If you have a trust that accumulates income, it doesn't pay it out, it accumulates income. Trust brackets get to the 37% bracket when they have $13,451. Look at the difference between the two. So when you talk about trusts, you have to understand they have the same brackets. They just get to that top bracket at $13,000. So you really have to think about when you're talking about doing trust, does it make sense to do a trust? And if so, how do I get around that 13,000? Maybe you invest in muni bonds, right? Muni bonds don't pay taxes. So, there are ways around this, but trusts pay the highest bracket very, very quickly. We talked about income limits to contribute to Roth IRAs. For 2022, these went up a little bit. Starting at 129, it starts phasing out and it's eliminated if you make more than $144,000 if you're a single filer, and if you're a joint filer, it gets eliminated totally. You can't do a Roth IRA if you have income in excess of 214. Now, there are some ways around this too. Some people have done this, and this was one of the things they wanted to get rid of, but they never did. You can contribute to a traditional IRA, wait a period of time, and then do a Roth conversion on it. And if there's not a lot of increase in that IRA, you're not paying much tax. That was one of the things that's called a backdoor Roth IRA. So you do a traditional IRA, You don't get a deduction because your income's too high. But then months later, you actually do a Roth conversion on that IRA. And if there's any, appreciation, you have to pay taxes on it. It's a Roth conversion. But because it's not been there for 20 years, it's only been there for a matter of months, you probably won't have a big tax liability. So that might be something you want to talk to your accountant about. They were trying to get rid of them and they didn't. So you might want to take advantage of it. And lastly, I'm going to blow this up a little bit. Capital gains are taxed a little bit different. It basically is taxed if your income as a single filer is below $41,600, you don't pay any taxes on capital gains. Married filing jointly, it's 83.3, 0 on capital gains, if that's included in your total income. Now, most people pay capital gains at 15%. And that's because if it's between the 0 bracket and for individuals, 459,000, or for married couples up to 517,000, you're paying capital gains at a 15% rate. And I apologize, for married couples over 517, single over that 459, you're paying capital gains at 20%. All this is in that book. And then Medicare, again, I went over this a little bit before. I just want to go over it briefly. Part A helps cover inpatient care in hospitals. You'll probably be paying 0 for this benefit. You should probably apply for it at age 65. If you don't apply for it when you're eligible for it, there is a penalty assessed on these things. You don't pay anything for Part A as long as you've worked for 10 years. I think that's usually the cutoff point. Part B pays for doctors, outpatient, care, medical equipment. D pays for drug coverage, and you can either go with Medicare or you can join a Medicare approved drug plan. Those are called Medicare Advantage plans. They're offered by private insurance companies, but they follow the rules set by Medicare. Medicare also has supplemental insurance. It's called Medigap. Extra insurance you can buy from a private company that helps pay for your share of costs of original Medicare. Policies are standardized, and in most states they have like K plan, L plan, D plan. They're all basically the same. So the difference is there's 2 ways, and I'll blow this up a little bit if you can see this. So the original Medicare includes Part A and Part B. You can join separate, as I mentioned. You can use any doctor in the United States anywhere. None of these plans cover if you're going to have retirement in Costa Rica. None of these plans will cover you there. With the original Medicare, you're going to have out-of-pocket costs. It's usually 20% co-insurance. And you can buy supplemental coverage, as I mentioned, like Medigap, or your former employee or union could have some kind of plan, or you could go on Medicaid, depending on your financial circumstances. Medicare Advantage is that Part C. Original Medicare had A, B, and D. There was C missing. Medicare Advantage is Part C. These are Medicaid approved plans. The commercials you see, they're bundled plans. They usually include A, B, and D. In most cases, you have to use the doctors that are in their network. They usually have lower out-of-pocket costs than original Medicare, and they can offer things like dental and vision which original Medicare does not. You really have to look at, and I'll also give you, there's a website where you compare plans. You actually go to the state where you are, and they'll tell you what's offered and what the different plans do. Once you opt out of Medicare, original Medicare, you can't opt back in. That's something you should be aware of. So once you go with a private company, you're going to have to go with private companies the entire time. There's been some, you know, you could go back and forth on this. There are some people that don't think that, you know, the long-term care that you get with a Medicare Advantage is as good as what you get with original Medicare. You know, I really think you just have to do your own research. And again, I cannot emphasize strongly enough, get Medicare in You 2022. I'll download it so you have it. It really does go through the benefits of each of these. Costs, again, for Part A, there's usually no cost. If you don't qualify or a spouse doesn't qualify, then there is a premium involved, and the premium is based, again, this was, remember when I was talking about doing a QCD and you know how it affects your premium for Medicare. Your premium will vary based on what your adjusted gross income was 3 years ago. So, you know, not having a lower adjusted gross income may be beneficial if you have to pay premiums on any of this stuff. You also have to sign up for Part B to buy Part A, and Part B has its own premium associated with it. So Part A has a deductible of, in 2022, the deductible is $1,556 each time you're admitted to the hospital per benefit period. And then after that, you know, 1 to 60 days, you don't pay anything. And then it increases between your hospital stays. Usually you don't stay in the hospital this long. The premium for Part B is $170 a month, and it comes out of your Social Security benefit. Usually, that's the way it's done. So it's each month, there's a premium associated with it. Could be higher depending on your income, but it usually just is netted against your Social Security benefit. And there is a late enrollment penalty, as I mentioned. It's an extra 10% for each year you could have signed up for Part B, but you didn't. So be aware that if you're eligible, you probably should sign up. Part B has a deductible of $233 in 2022. And there's a co-insurance of 20% that I mentioned. And that's really all I had. I am more than happy to take any questions if you're still awake. I will send the tax booklet. I will send the Medicare Go 2022 booklet. Anything else you may want, I'm more than happy to provide to you. If you have any questions, I'm here to answer them if I can. And if you want to just contact me later, I'll give you my email address. It's ttelega@tiaa.org. Make sure you put org on that. But if not, if you don't, thank you for listening. And if I can be of any help, I'm more than happy to be.
Can we have a silent clapping for this excellent
I'm clapping all of
presentation?
you. I'm clapping all of you. It's always a pleasure. Once the Secure 2.0 is passed, I will notify you all, and maybe we can just go over what actually did pass and what's going to be the law.
That would be great.
Yeah, my pleasure. All
Thank
of
you.
Take care.
Thank you, Tamara, and thank you all for attending.